Impact of US tariffs on pharmaceuticals, global and investment implications. Imagine waking up to the news that the cost of life-saving drugs in the US is about to skyrocket. Why? Because the President of the United States, Donald Trump, has announced a 25% import tariff on pharmaceuticals. Now, this move isn't just about taxes, it's about reshaping global trade and manufacturing. But here's the real question: can America sustain this decision? How will it impact Indian pharma? And most importantly, should you buy beaten down pharma stocks right now? Let's break it down. Why is Trump increasing tariffs? Trump's America First strategy isn't new. He's always pushed to reduce dependence on China and India and bring back manufacturing jobs. But here's the problem: the United States of America heavily depends on Indian pharma for affordable generic drugs. India supplies a massive 47% of America's generic medicines, worth nearly $8.73 billion. Now, if Trump's goal is to make America self-sufficient in medicine production, that's easier said than done. Setting up domestic API, active pharmaceutical ingredient, production takes years, and America doesn't have the infrastructure to replace Indian suppliers overnight. The moment this news broke, the stock prices of Indian pharma giants Dr. Reddy's, Cipla, Lupin, and Sun Pharma dropped by up to 10%. Investors panicked because a 25% tariff could cut into these companies' profits from USA. A Nomura report estimates that Indian pharma earnings might drop by 6.5% in FY26 if these tariffs are enforced. Biggest losers? Companies heavily dependent on US exports, like Dr. Reddy's and Lupin, will feel the pain. Possible winners? Sun Pharma and Torrent Pharma, which have a strong domestic market and lower exposure to the US, might be more resilient. Now, let's flip the script. How does this move affect America? Drug prices will surge. With tariffs increasing costs, US consumers may have to pay more for essential medicines. Possible shortages: America doesn't manufacture enough APIs domestically. 90% of essential medicines rely on imports. Cutting off affordable imports could create a healthcare crisis. FDA bottlenecks: even if the US tries to build a local pharma industry, FDA approvals for new plants and suppliers take years. So, what's the likely outcome? A policy reversal or exemptions for Indian pharma if the situation worsens. How can Indian pharma survive and thrive? Smart companies don't wait for policies to change, they adapt. Diversifying exports: Indian pharma is already expanding into Europe, Latin America, and Africa to reduce dependence on the US. Production-linked incentive scheme for API production: the Indian government is incentivizing local API manufacturing to cut reliance on China. Innovation and R&D: companies focusing on high-margin specialty drugs will be better positioned. Stocks to watch: Sun Pharma, less reliant on US generics, strong domestic market. Lupin, diversifying its pipeline with complex generics. Cipla, stronghold in chronic and respiratory drugs. Dr. Reddy's, still a global player despite US reliance. Final investor strategy and call to action. So, what should you do as an investor? Short term, expect volatility, but don't panic. Stocks may dip further before stabilizing. Long term, companies that diversify and innovate will emerge stronger. Actionable tip: track government policies and buy strong pharma stocks on dips. What's your take? Do you think this tariff will last? Which Indian pharma company will navigate this crisis best? Comment below. Let's discuss. Like, share and subscribe for more financial Zen insights.